Why does a tiny 0.25% change cause the market to crash? What does that same number decide if you can afford a house? And why is the entire global economy seemingly held hostage by this one thing? The answer is the federal funds rate, which we'll just call R. Because it's not just a number, it is gravity. It dictates the weight of every single dollar. In the next 20 minutes, you will see the exact mechanical link. You're going to understand the algorithm of value. You are going to master these concepts. So here's the roadmap for where we're going. First, we'll look at your monthly budget and the price of leverage. Then we'll dive into your stock portfolio to understand asset gravity. After that, we'll talk about your job security and something called the hurdle rate. And finally, we'll cover cash and inflation, the Fed's thermostat for the economy. But here's the core idea. The single most important thing to remember is this. R is the denominator. Bigger denominator, smaller value. Okay, let's start with your wallet, your monthly budget. The most immediate impact of that little number R? It's the price of leverage, a fancy word for debt. But what's the real price? It's not the sticker price of the car or the house. The real price is the monthly payment. That's the number that decides what you can and can't do. Let's make this real. Imagine your dream house, the asset. The sticker price is $300,000. Now, imagine two worlds. It's the exact same house, same bricks, same yard. But in each world, there's a different gravity, a different R. Let's look at case A. This is the low-rate world, where R is just 3%. The math is pretty simple. $300,000 times 0.03, that's $9,000 a year, which means your monthly interest is about $750 a month. Okay, that seems manageable. But what about case B, the high-rate world? Now, R is 7%. $300,000 times 0.07 is $21,000. So your monthly interest payment is now $1,750 a month. Let that sink in. That's a $1,000 a month difference for the exact same house. The cost of renting money from the bank just more than doubled. Your buying power, gone. Now that was just a quick estimate. The banks have a much more precise way of doing things. Let me introduce you to the amortization algorithm. This is how the bank calculates your life. You can see the formula on the screen. M equals P times, well, it's a bit of a monster. Don't worry about memorizing it. Just know the inputs. M is your monthly payment. P is the principal. That's our $300,000. R is the monthly interest rate. And N is the number of payments. For a 30-year mortgage, that's 360 payments. So what happens when we plug our numbers into the bank's own algorithm? This is the reality check. Look at this table. With the loan amount of $300,000 at a 3% rate, your monthly payment is $1,265. Okay, but at a 7% rate, your payment jumps to almost $2,000 a month. But look at that last column, the total interest paid. At 3%, you pay about $155,000 in interest over 30 years. At 7%, you pay over $418,000. That's more than the house was worth in the first place. Here's the brutal truth. You are buying the bank a house, and in return, they let you live in yours. Now let's scale the pain. This isn't just about mortgages. Think about auto loans. That $40,000 truck, the monthly payment spikes. Sales drop. Think about credit cards. Your variable APR jumps from 15% to 25%. Your balance becomes crushing. And this leads to something critical in housing, a phenomenon called the freeze. Let's walk through this flow, treacher. You're a homeowner and you've got a great 3% rate locked in. You're thinking, maybe I want to move? So you check the new rates, and it's 7%. Your new payment would double. So you ask yourself, can I afford it? No. So you cancel the sale. You stay put. And when everyone does this, the supply of homes for sale just vanishes. The market freezes solid. Because at the end of the day, the Fed controls the price of admission. And when R goes up, fewer and fewer people can afford to get into the game. Okay, so we've seen how the Fed can crush the housing market. Debt gets expensive. That feels obvious. But that begs the question, why does the stock market, something that feels totally separate, also crash? I mean, why does your stock portfolio get hammered the moment the Fed hikes rates, even if the companies you own are doing great and making the exact same amount of money? It's because of a fundamental law, a kind of financial physics. The value of any asset is simply the present value of its future cash. That's it. That's the secret. Let's break this down. Imagine a perfect theoretical company. We'll call it Cash Flow Incorporated. This company is a rock. It's not a startup. It's not growing. It's just solid. It has a magical contract that guarantees a dividend payment to you of exactly $10 per year, forever. No more, no less. So here's the million-dollar question. What should you pay for one share of this company today? The answer, and this is the key, has almost nothing to do with the company. It has everything to do with your alternative. Specifically, the alternative the Fed is offering you. They call it the risk-free rate. We'll just call it R. It's basically the return you get for doing absolutely nothing. Let's run the numbers in two different worlds. First, case A. We're in a low-rate world. The Fed has set the rate, R, at 5%. The bank will give you 5% a year, guaranteed. You want to earn $10 a year. So, quick question. How much cash would you need to put in the bank to generate that $10? The math is simple. $200 times 5% equals $10. Therefore, in this world, a share of cash flow incorporated is worth exactly $200. Simple. But now, case B. The Fed chair walks to a podium, taps the microphone, and announces a rate hike. Rates are now 10%. The bank is paying you double what it was before. Let's ask the same question. How much cash do you need in the bank now to get that same $10 return? The math is even easier. $100 times 10% equals $10. So now, the stock is only worth $100. The stock price just experienced a 50% crash. Let that sink in. The company did nothing wrong. It's still a rock. It's still churning out that guaranteed $10 a year. So what happened? The safe alternative, just sitting on cash in the bank, became more attractive. That's all. This is asset gravity. As the risk-free rate goes up, it creates a gravitational pull that drags down the value of everything else. Stocks, real estate, art, you name it. It's an unbreakable rule. Look at this diagram. When the rate R goes up, the price of assets goes down. They move in opposite directions, always. Now, Wall Street doesn't just do this in their heads, they formalize it. They use a model called discounted cash flow, or DCF. For a company like ours that pays out forever, they call that a perpetuity. The formula is brutally simple. You can see it on the screen. PV equals CF over R. PV is the present value. That's the stock price we're trying to find. CF is the cash flow. That's our guaranteed $10 dividend. And R is the Fed rate, the discount rate. Notice where R is. It's in the denominator. And what happens when you make the denominator of a fraction bigger? The whole value gets smaller. If you visualize this gravity, you get a curve like the one on the screen. As the rate R moves to the right, the price PV just plummets. Okay, let's bring this into the real world. How does this explain the difference between, say, tech stocks and utility stocks? Think about stable, dividend-paying stocks, companies like Coca-Cola or a boring utility company. They are a lot like our cash flow Inc. They generate their cash flow today. The formula is our simple one. PV equals $10 over R. When rates go up, they feel pain, sure, but it's linear pain. It's predictable. Now think about high-growth tech, startups, the NASDAQ. They aren't promising you $10 today. They are promising you $1,000 10 years from now. And look at that formula. PV equals $1,000 divided by 1 plus R to the power of 10. That denominator isn't just getting bigger, it's being squared, cubed, raised to the 10th power. When rates rise, money in the distant future becomes almost worthless today. This is why the NASDAQ crashes first and hardest when the Fed starts hiking. It is not emotional. It is not a panic. It is just math. All right, we've talked about how interest rates create a kind of gravity for big things like stocks and real estate. But this number, R, it decides something far, far more personal. Think about this for a second. Why do perfectly profitable companies that are making money hand over fist, suddenly announce hiring freezes? Or even worse, layoffs? The answer is opportunity cost. Here's the hard truth. Making a profit isn't enough, not even close. To get funded, to get hired, you must beat the bank. Let's make this super concrete. Here's the pitch for hiring you. The cost to the company is $100. Your salary, your equipment, whatever. The return you'll generate is $110. Simple profit, right? $10. That's a 10% return. So, should the boss hire you? The answer is it depends entirely on R. Let's run the numbers. Your boss has two choices. They can invest that $100 in your project, or they can put it in a completely safe government bond and earn the bank rate, risk-free. Scenario A. We're in a low-rate world. R is just 2%. The safe alternative, the bond, turns that $100 into $102. Your project, on the other hand, turns it into $110. $110 is way better than $102. The decision is obvious. You are hired. But now, scenario B. The Fed jacks up rates to fight inflation. R is now 12%. The safe alternative, that boring bond, now turns $100 into $112. Your project still makes $110. Suddenly, your profitable project is a loser. Why would they risk money on you for $110 when they can get $112 for doing nothing? The result? You are fired. Listen to this. This is the most important part. Your project didn't change. Your 10% return was always a 10% return. The bar just got higher. We call this the hurdle rate. Look at this flowchart. You have a new project idea. The first question is always, can it jump over R? If yes, you get funding, you get hired. If no, the project is killed. You're fired. When R goes up, that jump becomes almost impossible for a lot of projects. Now, corporations don't just use vibes for this. They use a precise formula. It's called net present value, or NPV. This is the corporate decision formula. As you can see on the screen, NPV equals R divided by 1 plus R minus I. I is the initial investment, our $100. R is the return, the $110. And R, that's the hurdle rate, sitting right there in the denominator. The rule is simple. If the NPV is positive, it's a go. If it's negative, you kill it. Let's see the NPV in action. First, the low-rate world, where R is 0.02. We take 110, divide by 1.02, and subtract 100. That comes out to about 107.80 minus 100, which equals a positive $7.80. Project approved. Now, the high-rate world. R is 0.12. 110 divided by 1.12 minus 100. That's $98.20 minus 100. The result is a negative $1.80. Project killed. Now, scale this up from our $100 project to the entire economy. 1. Venture capital. When rates are high, all those high-growth startups suddenly fail the NPV test. Funding completely dries up. 2. Construction. A builder won't start a new apartment complex if the loan interest is higher than the expected profit from rent. New building projects get canceled. The result of all this? Less building, less expansion, fewer jobs. So here's the final, brutal takeaway. The Fed raises rates to intentionally make projects fail. It is a deliberate act to cool down the engine of the economy. Okay, so let's recap. Raising rates makes debt impossible, it crashes the stock market, and it puts people out of their jobs. This sounds absolutely terrible. So why on earth would the Fed inflict this much pain on purpose? The answer is that the Fed sees itself as the economy's thermostat. Here's how it works. When the economy runs too hot, that's inflation with prices soaring, their action is to raise rates. They need to cool it down. On the other hand, when the economy gets too cold, like in a recession, and everything is freezing up, their action is to cut rates to heat it back up. Right now, the problem is that the economy is too hot. There is simply too much money chasing too few goods. So their goal is actually very simple. They need you to stop spending. But they can't force you. They can't just command you to close your wallet. No, they have to convince you. They have to bribe you. Let's look at this decision between spending and saving. Imagine you have $1,000 in cash right now, and your goal is to buy a new TV. So the question is, do you buy that TV now, or do you wait a year? Well, it all depends on the size of the bribe, which we'll call R. Let's look at case A. We're in a low-rate world where R is only 1%. The bribe to wait, well, let's do the math. $1,000 times 0.01 is $10. You're telling me I have to wait a whole year for a $10 reward? That's barely a sandwich. My decision? I'm going to buy the TV. And when millions of people do that, inflation goes up. But now, case B. We're in a high-rate world. R is now 5%. The bribe to wait? $1,000 times 0.05 equals $50. That's a 5 times bigger return, plus you get compound interest. Suddenly, saving that money seems like a pretty smart move. My decision? I'm going to save the money. And when millions of people do that, inflation goes down. And when everyone stops buying, what happens? Stores lose customers. And to get you back in the door, prices must fall. This is the weaponization of the time value of money. It's all based on a very famous formula, the compound interest formula. This is how they calculate the precise size of the bribe. As you can see on the screen, future value, or FV, equals present value, PV, times 1 plus R to the power of N. In our case, PV is your $1,000, N is the number of years you wait, and R, well, R is the Fed rate. That's the bribe. So let's calculate the 10-year bribe. How much will the Fed pay you to wait a decade? At a 1% rate, your $1,000 turns into $1,104. Versus, at a 5% rate, that same $1,000 turns into $1,628. The difference is an extra $524. That's more than 50% of your starting cash just for waiting. And this brings us to the full machine, the entire system in one picture. This is the monetary transmission mechanism. Look at this diagram. This is how the Fed controls everything. At the top, the Fed raises rates. That sets off a chain reaction. It leads to debt pain from Section 1, it causes stocks to crash from Section 2, and it creates that saving bribe we just covered in this section. All three of those paths lead to one outcome: less spending. When people spend less, companies sell less. And when companies sell less, they start layoffs, which we covered in Section 3. And all of that pain, all of that slowing down, leads to the ultimate goal: lower inflation. But there's a huge risk. The Fed is basically trying to fly a 747 with a pipe wrench. It's not a precise instrument. They are aiming for what's called a soft landing. This is the dream scenario. Inflation falls, but unemployment stays low. It is extremely difficult to pull off. The other possibility is the hard landing, the nightmare. This is when they overshoot. Debt defaults start piling up from Section 1. The market has a full-blown crash from Section 2, and you see mass layoffs from Section 3. Here's the key takeaway from all of this. They manipulate your psychology. They change the numbers to make you feel poorer from your crashing stocks and to make saving look way smarter than spending. And when you finally close your wallet, the Fed wins. So, we've come to the end, the conclusion. Let's talk about the universal denominator. The Fed funds rate, R, isn't just some number you hear on the news. It is the universal denominator. It all comes back to the source code, that one simple formula we've seen again and again. Take a look at the screen. Value equals cash flow divided by R, and the law of math is undeniable. A bigger R, a bigger denominator, means a smaller value. Period. It's just that simple. So think about what that means. The person who controls R has the power to resize reality. So let's put it all together. This is your cheat sheet, the matrix of money. And I'm serious, screenshot this. This table shows the Fed's 4 levers. Let's walk through them. First, the area is your debt. The concept here is debt service, amortization. When R goes up, what happens? Your monthly payments explode. The result? You can afford less house, less car, less everything. Next area, your assets. The concept is discounted cash flow. PV equals CF divided by R. When rates go up, future cash becomes almost worthless today. The result is that stock and real estate prices get absolutely crushed by gravity. Next up, your job. The concept is the hurdle rate, that net present value calculation. When rates go up, projects that were once profitable are suddenly killed. They're just not worth the investment anymore. And the result? Hiring freezes. And then, layoffs begin. And finally, your cash. The concept is opportunity cost, or what we called future value. When rates go up, that reward for saving becomes irresistible. And what's the result? You stop spending. Everyone stops spending. And inflation falls. And this all reveals the big secret. Are you ready for it? There is no such thing as a fixed price. A price is just a reflection of the interest rate. So let's create a translation layer for this. Let's start with housing. The question you're probably asking is, when will house prices finally drop? But the reality, the question you should be asking is, when will rates get high enough to make mortgages unaffordable for everyone? Okay, how about stocks? The question you might be asking is, when will the market rocket back to the moon? The reality of that question is, when will the Fed lower rates back to zero? You now possess the source code. The next time you see the Fed chair walk up to that podium, you won't just hear a percentage change. You will see the variables of your own life being rewritten in real time.